Hello, this is Jordan, and this is your precious metals video market update. This video is being recorded on the evening of Sunday, May 12th, 2019. I hope everyone had a great Mother's Day. In this video, I'm going to analyze the gold stocks, and specifically GDX in some detail. So starting off here, we have a daily bar chart of GDX. And then below that, we have two breadth indicators that I've customized. And those are first the percentage of stocks in the Huey that closed above their 50-day moving average. And then the bottom one is the percentage of the stocks in the Huey that closed above the 200-day. And so these are breadth indicators. And the Huey is basically GDX minus the royalty companies. That's why GDX has been stronger than the Huey in recent years. And I prefer to use these breadth indicators for the Huey because the Huey doesn't change as much. GDX, the managers of that, they're adding stocks and moving stocks too often. So it's easier for me to track the breadth indicators for the Huey, but I still like to use them with the chart of GDX. So that's why I do that. But essentially what we're seeing is we're seeing a technical breakdown in the gold stocks, and the gold stocks are very oversold, but only on a short-term basis. And so in these indicators, you can see that the percentage at close above the 50-day, that's down to 5%. I also track the percentage at close above the 20-day, and that's also, I think, 5% right now. But the percentage that have closed above the 200-day, that's been coming down, but that's still at 45%. So as far as these breadth indicators, the most similar situation is you have to go back to October 2016 where the market was correcting in very hard fashion after that peak in the summer, and it got really oversold really quickly on a short-term basis. But, after some bounces, it kept declining because the percentage of the stocks were above the 200-day. That remained relatively high. That didn't start to come down until the very end of September, which was almost 2 months after the market peak. So that's similar to where we are now. So again, the percentage of close above the 200-day, it's 45% for the Huey. I also track these for GDXJ. It's 37% for GDXJ. So when those indicators get below 15%, or maybe it's below 10%, and the short-term indicators are also showing similar readings, that's when we know that the market is extremely oversold and we're close to some rebound that's probably going to last at least a couple weeks, probably longer. And we're just not at that point yet because the miners, they've already broken down and they're still in breakdown mode, selling off. And again, as I said, on a long-term basis, if we're looking at the 200-day, the miners are not that oversold, and so that's the problem. And assuming they trade lower, and they keep trading lower, eventually you'll get that extreme oversold condition on all time frames. And if that coincides with a test of support there, as you can see, I've outlined it at 17 or 18. Then you have the setup there for a predictable rally. So as far as being bullish in the near term, that's what we should be waiting for here. That's what I'm waiting for. It's way too early to get in front of this. And so this is more of a short-term look of GDX, or just not quite as much of a long-term look because I do show a couple years here. But we have GDX. It's a bar chart at the top, and below that we have the GDX advanced decline line, and then we have the GDX to gold ratio at the bottom. And even though it's on a very short-term basis, there is a clear negative divergence. GDX has not made a lower low over the last 10, 12 days or so. But look, the advanced decline line has already made a lower low. GDX against gold has already made a lower low. So those are leading indicators. They've already made a lower low. That bodes poorly for GDX. GDX, therefore, is very likely to make a lower low soon. And I highlighted something and specifically the price action of the last couple weeks. And it's probably hard to explain it given that the image is not in great detail, but and this is also true for GDXJ and any mining index you want to look at. They've formed a bearish running correction, which is really bearish. You can also get a bullish running correction, which is really bullish. But in a typical correction, there's 3 legs. So you usually have down, up, down. And typically the 2 down legs are the strongest because it's a correction. It's correcting, it's going down, so the down legs are the strongest. However, in a running correction, you have the opposite where it's down, up, down, but the 2 down legs are the weakest, and the strongest leg is the up leg. So in a bearish running correction, typical bearish correction when the market's going down, it's the opposite. So it goes up, down, up. So typically those up legs should be the strongest. However, what we've seen happen is we've seen a weak rally, then a sharp down leg, and another weak rally. And in the last couple of days, the market is starting to begin a new leg down. And so that bearish running correction, essentially, when you get that, there's no correction in price. You know, the market, because of the running correction and how it the legs act opposite of how they usually act, you basically get no correction as far as price. But in terms of time, there is a correction. And so therefore the market corrects. It doesn't correct in price, but it corrects as far as time. And so that time works off that oversold condition or the overbought condition. So I know it was a little confusing, but I wanted to point that out. But that's something I do see over the last couple weeks, is that we do have a bearish running correction. And so I would not be surprised to see this sell-off really continue or pick up a little bit over the next couple weeks. Now, there's 2 things here which are really important to watch as far as, one's technical, one's fundamental, as far as, what can give us a good indication that gold stocks are probably going to turn around, or I should say finally turn around and begin a bull market. Now, one thing is they need to perform against the stock market. And if you look at history, there's never been a real bull market in precious metals without gold outperforming the stock market, except 85 to 87. That's because there was a massive decline in the dollar. But what we're looking at here, we have gold against the S&P at the top, and then we have GDX against the S&P at the bottom. And these ratios remain in downtrends, but there is a chance perhaps in the months ahead that they both could make double bottoms. So that's something I'm keeping in mind. Again, I don't think this is something that's imminent as far as the next month or 2, but maybe we get 3, 4, 5 months down the road. We get towards the end of the summer. Perhaps these charts can form double bottoms, and that would be really encouraging, as we finish out the year. Now, the other thing which I've talked about in lots of articles and I think my last couple videos is the Fed. You go back over the last 65 years, in 11 of the last 13 rate cut cycles, gold stocks had an average gain of 146%. Now, I think I'll have to look at this again. I think I didn't update this because when I looked at it again, I think it was 170%. But anyway, that's not terribly important. The real key in looking at this is that the end of hikes, when the Fed does its last hike, that is important. But the real key that gets the bull market going in the gold stocks is when they do the first rate cut. And if we think about what's happened over the last, 3, 4, 6 months or so, until the last couple months, the market at one point had priced in a full rate cut by January 2020. Now the odds of that are somewhere in the 70s. So it's still relatively high. But, that percentage can come down in the meantime if economic data gets better, or if, the stock market makes a new high and has more upside. So those are things to keep in mind. But the real big point is I don't think we're going to see the start of the real bull market in precious metals until the Fed makes that first cut of their new cutting cycle. So for now, it looks like we're still probably early, but you never know. If there's really bad data and the market can't break out, maybe the odds are that we do get a rate cut by the end of the year or in January or whenever. But this is really important to keep in mind. It's the rate cut itself which really starts the bull market and starts the outperformance as far as precious metals outperforming gold stocks. That's all for this video. You can find all of my work at thedailygold.com. Be sure to check thedailygold.com. I'm updating the book I wrote a couple years ago. It's just about done, but I'm editing it. So sometime in the next month, get on my email list. You can get a free copy of that. It contains all my work, all my best research, my outlook / predictions for what could happen over the years ahead, over the next 10 or 20 years in markets. So again, go to thedailygold.com, get on my email list. I will send you a copy of that when it's done. Dailygold.com/premium. It's only $149 for 6 months. Our focus is market timing and stock selection. Now, let's get into the best stocks, and at the right time, we use a disciplined approach in trimming positions and cutting losers. Right now, there's some great opportunities in individual names. I might talk about that a little bit more in a future video. Look, for precious metals, it's still a stock picker's market. There are some companies that are diverging and doing well. Therefore, there are some opportunities right now. And I think as we see more weakness in the sector, we'll see a lot more opportunities in 3, 4, 5 months from now. So don't use all your dry powder right away. Thank you so much for watching this video, and I look forward to publishing another video update for you over the next couple weeks.